Hi, Brian.albrich here, retirement mortgage specialist with Fairway Home Mortgage. I talk a lot about HECM or reverse mortgage. That's FHA's term for reverse mortgages, HECM, home equity conversion mortgage, and how FHA actually insures them and assures that both the government and the borrowers that these are a very safe product. And they weren't always that way, but they are always trying to update with safeguards for both the consumer and the banks and the government that does these. So some of the required safeguards are mandatory counseling for all the borrowers. So no matter who's getting one of these, needs to take counseling with a neutral third party, and I think that's very important. I I think a lot of people used to think that you could just get one of these, never make a payment, and never worry about anything. But there are some requirements like paying taxes and insurance that the counselor makes sure that the borrower understands. There's some cross-selling restrictions. They used to have, people pull money out, when I say they, I'm talking that you get a bad lender and a bad financial advisor, and they'd have people pull money out to buy investments. That is a no-no, and we have paperwork that addresses that throughout the process. There's also initial disbursement limits. Back several years or decades ago, used to have access to all of the money right out of the gate when you get one of these, and that's been limited, primarily to protect the consumer, from themselves or their family. Frankly, make sure nobody's taking advantage of them, pull all the money out, and then not be able to, pay their obligations like taxes and insurance. There's a credit and income review. There's protections for the non-borrowing spouse, meaning if you're under 62, you can still be on title, and that is something that's been fixed. That not used to not be the case, and that was very problematic. The HECM line of credit is guaranteed access and built-in growth. Even if the home value goes down to $1, the line of credit is based on the original appraised value, and that always grows at the note rate. And again, it's a non-recourse loan, meaning the borrower nor their heirs are on the hook for anything owed above and beyond what the house is worth. So these are all pretty good protections for the consumer.